everyone.
Hi, everyone. Please grab a seat. We'll get started. So I wanted to start off with a quick market stats. Should give you an idea of this first slide is a total residential price, so across all property types. And most of you, if you've been following the market, you'll know the market's starting to slow down a little. And that's reflected in pretty much all these metrics. So benchmark sales price is down 4% year over year. And then our average days on market are up over 50% at this point. So it's taking at least 42 days for the typical property to sell. Months of inventory have gone up. There's 4 months of inventory now. That's over 50% where it used to be compared to last year. And the number of sold listings is also dropping. So new listings are coming on and they're taking longer to sell, and less of them are selling as well. Okay, which is driving up the months of inventory. So this slide on your left, it's the detached, and then I've got semi-detached. So you'll see a very similar story where benchmark prices are going down, days on market are going up, months of inventory are going up as well, 50% for the detached. The semi-detached, almost 90%. And what's really contributing to a lot of these are the suburb or the new neighborhoods where there's so much construction going on. A lot of them are semi-detached, and often with basement suites as well. Okay? And then row houses and townhouses, that's this slide here. There's been a huge increase in terms of months of inventory for condos, as well as townhouses. And we expect that this is probably going to get worse. There's going to be a lot more supply in this space, and it's taking a lot longer to sell them as well. Just looking from the stats and from our experience selling these product types right now, we can tell you that it's much harder to sell a condo or a townhouse, with exceptions, right? If you have a property in a really, really good location, it shows really well, they still sell. Okay, so this is just a map of all the different zones of the city, and the benchmark price drops year over year. And interestingly, you'll notice that the largest pullback in pricing was actually in the northeast, followed by the east zone, which is kind of the Forest Lawn and surrounding area. And the reason why is because these areas went up the most in the last couple of years. Okay, and these areas went up the most. Why? Because they were the most affordable areas. So when people's qualifying was tight, this is where most people could end up buying, right? So right now they're experiencing a larger pullback in pricing relative to other quadrants. Okay, so on your left, this is the total months of inventory. So right from around COVID, you'll see inventory went up for a bit, and then our market became hotter and hotter, so months of supply went down, and it's starting to go back up. So if we can predict where it's probably gonna go, it's likely going to keep going up is what we're expecting. And then on the right side, you'll see total prices. So you'll see average price and benchmark price. So they're pretty much trailing each other at this point. And average prices are starting to come down. Same with benchmark prices as well. Okay, so we'll skip that one. So population growth. Alberta has been leading the country in population growth, mainly because of people coming in from primarily Ontario and British Columbia. Okay, but you'll now see that population growth in Alberta is dropping, and so is the rest of the country. But interestingly, we still have a larger percentage relative to the rest of the country when you look at population growth. Okay, and this is a good indication that overall population growth is declining, but we're still higher than the rest of the country. And this just builds upon the previous slide. It just shows you the breakdown of where this population growth is happening. And primarily what's driving Alberta's growth is international migration. And then just after that, interprovincial, and then a small portion is the natural increase. Okay, so moving on, let's move to the rental market. How many of you have tried renting a unit recently? And how was that experience? Tough. Yeah, tough. That's what we're hearing. So rents are dropping across all property types. So Anthony's going to talk a little bit more about how to make your property competitive to get it rented sooner in a bit. And supply is increasing steadily, right? And a big portion of what's adding to all the supply is a lot of purpose-built units, condo buildings that developers built to sell, but then they couldn't get their price, so they're being converted to rental units. Okay, so this table here at the bottom is from rentals.ca, and I just pulled it this morning just so it's updated. You can see these are apartment rents, apartment condos. 2-bedroom rents are down 7% year over year, and one bedrooms are down almost 6%. Okay, and this is a very general across the whole city. Depending on where you are in the city, this could be higher or lower in some cases. Okay, and then the right side is a very general, all property types. In Calgary, we're down almost 9% year over year for rents, but pretty much every large city in Canada is experiencing some type of rent decline. So, okay, purpose-built rental starts. So this is kind of what's really adding fuel to the fire right now. In 2025, you can see Calgary had a huge run-up in purpose-built rental starts. And it's not just Calgary. Edmonton has a similar trend going on. In fact, Edmonton's building way more purpose-built rentals. And Calgary and Edmonton are very attractive to do purpose-built rentals because programs like the MLI Select, which is a commercial financing product, they work really well in Alberta. And it's very easy and relatively shorter timelines to get permits to get stuff built, right? So a lot less red tape, the program works better. So when we realize that we have a shortage of units, Alberta developers are really quick to jump on it and get the supply up, right? It's important to note that a lot of this also doesn't include projects that are already that have purchased the lots but haven't started building, but have already started the groundwork for it. So these are not still reflected in the housing starts yet, okay? So more on the rental market, vacancy rates are rising, and I touched upon this earlier. Properties in the suburbs, condos and townhouses, they're being hit a lot harder, okay? In terms of vacancy, what are we seeing? We used to be using 3% when we ran our numbers for vacancy when the market was really hot. Now the typical number you were using is 5 to 6%. And depending on the area, I would say it could be as high as 8 to 9%, right? And especially if you have one bedroom basement suites in the suburbs, you will notice that your rents have come down a lot and there's a lot of units on the market that are very similar to yours competing all to get the same tenant, okay? This figure here just shows the asking rents and how they've changed in the various cities. Obviously in Calgary, we're seeing some pretty big rent drops depending on property, the 1, 2, or 3 bedroom. And the only other city that's Edmonton, the reason why it's gone up slightly is their market's still relatively hot, although that's starting to change. So I'm expecting that these numbers are gonna be all in the negative, not so far in the distant future. The only other one that's gone up is Montreal, and the reason why is their housing starts are still quite low. They're not adding a lot of supply, which is keeping the rents high. And Toronto and Vancouver, they built a ton of condos. There's a glut of condos, so rents are coming down for those. So how can you prepare for a declining market or slower rental market? Anthony's going to touch upon that.
Yes, as Santhosh discussed, the rental market's a lot slower than what we've had especially in the last few years for Calgary, right? But it doesn't impact everyone the same way. So yes, depending where you are and what property type you have, you'll have different vacancy, but also dependent on the property itself. So things like if you have a weird layout in your house that might have rented no problem a few years ago, but right now tenants are a lot pickier of the unit, they want good quality rentals, so those become a bit harder, right? Maybe your walls need to be repainted or it's a little bit more of in need of a refresh. Now is a great time to do renovations in these units. Trades will probably start to get a bit more available too. It's not quite the case yet, but as the market continues to slow down, and you want to have essentially your best foot forward right now to attract good tenants, right? We see it right now with our own portfolio. We can still get the units rented, but we have to be competitive. We have to have good marketing. And we have to have good units, especially, right? The ones that are a little bit odd or in areas that maybe are not as attractive or struggling a lot more. So now is the time to really have the right properties. And yeah, Santhosh was talking about housing starts on the rental side, purpose-built rental, but in terms of all housing starts, including single-family homes, condos, and whatnot, this is where really we see the difference in Calgary and Edmonton on a per capita basis. Especially with 2025, which, like Santhosh said, I don't think it fully reflects yet what's happening or what's in the pipeline. We're quite high, right? So it's a lot of extra supply that we've added on the market. I did add a chart too, going all the way back to 1950 for all of Alberta. And, the actual numbers are not so much relevant because obviously we have way more population now than we did in 1950. The trend, however, is the interesting part, right? Because you can see, the 1980s downturn, we had a huge drop in housing starts, right? Same thing, around the 2007 drop. And we expect that we're going to see another drop here too, right? The idea is that builders are not going to start to pump inventory on the market if there's no buyers for them, right? So that's why this will sort out. The slowdown in the market will eventually sort itself out because we have a free market that adapts to the demand that we have. So housing affordability, this one is really interesting. We're all looking at it and seeing, how affordable Calgary has become nationwide, right? Yes, Edmonton's more affordable. It's not on the list. It would be lower. But in the large cities, we're more affordable than Montreal now. We're more affordable than the national average by a big margin, and definitely Toronto and Vancouver. And if you look here, that wasn't always the case. Calgary used to be, pretty good, but not in the best of affordability. And there's a few reasons for that. Our incomes are high, and this is looking at, median rent mortgage compared to income. But also our prices, although they have gone up, they haven't actually gone up that much, especially once you look into the past 10, 15 years, right? We've had a few years of really high price growth, but that's only a few years, right? The 7, 8 years before that, we essentially had a flat market while those other markets were going up steadily every year. And this is really important because I think it really makes us more resilient going forward, longer term, because people want to move where it's more affordable, especially when you see those kind of spikes, right? It's getting difficult for a lot of people in the country, including in areas that historically were much lower, like Montreal. And this chart kind of illustrates that as well. So the more expensive you go on that chart, the more of a price drop you see right now, and the cheaper you get, with the exception of kind of the middle pack here, the more price growth you see, right? The sub 500K is still seeing significant price growth at the moment, and that's an affordability pursuit, I think, for a lot of people. There's a lot of people moving from province to province, and we'll see that later on. Net interprovincial migration. Although, like Santhosh mentioned earlier, the population growth as a whole has slowed down significantly in Alberta, we still get a lot of interprovincial migration. And interprovincial migration is interesting because it's much more organic of a population growth than international, because international migration is driven a lot by government policies, where interprovincial migration happens because of actual attraction to our province, right? The governments don't control how many people we get from other provinces. Anyone can just freely move. It has to be attractive for people to do that. And we can see it still is very attractive. And additionally, younger people, for the most part, are moving from province to province, which makes our province more dynamic and, higher participation rate and all that. And we can see that Ontario is still the biggest loser, although Quebec has really picked up. Looking even last year, Quebec was getting a few people, but not that much. And I think that because their prices are going up so fast right now still, and ours have kind of tapered down, that helps to bring people over, especially when they see they can get higher income here and potentially different job prospect. Has political reasons as well, but and this kind of covers that a little bit. So that study just came out looking at social mobility. So social mobility is it's essentially how easy it is for someone that's a lower income social bracket to go up, right? So you have a lower salary and you're looking to improve your income, how easy it is to do. And Alberta came up first and Quebec came up last. And a lot of the reasons why Quebec came up last was what they call the artificial buyer score. And that's essentially regulations and taxes from government. And they're pretty far from what Alberta is. This really matters for interprovincial migration, right? Because when people are kind of getting tired of their situation and they want to make a change, they're going to look at, okay, do I need to move, and if so, where? And where the place to move in the country, right? From that perspective. So Alberta Oil and Gas. as most people that have been in Alberta for the last 10 plus years know here, it's been slower, than it's been in the past. But the last few years have been picking up a little bit. And this is really important given all that's happening with the US, the tariff threats and all that. We're really diversifying our own gas export. I mean, this is looking back all the way to 2012. We had very little exports outside of the US. And now we're starting to get significant exports, and it's been improving as we get TMX pipeline online, as other pipeline, LNG right now in BC as well, which opens markets in Asia, Japan, China, and whatnot. So this is making us more resilient now for future potential issues with the US. And if we solve the trade war issues, then that's still there, right? We still have those extra markets to export our energy to. But, and there's a but, there's a slowdown in capital in the oil and gas. So at least there's been a few layoffs that have been announced recently. Imperial Oil is essentially leaving Calgary almost altogether. They're shutting down their headquarters in Quarry Park, and it sounds like they're moving a few of the remaining people to Edmonton. Now they're still going to have operations in Alberta, but in terms of the Calgary staff, it's a significant reduction. And ConocoPhillips has announced they'll cut worldwide 25%. And when they were asked about the Canadian situation, they seem to think it would be around 25% as well. This is not good news. However, it seems to be mostly driven by efficiency in the oil patch. It's not like we're producing less oil. We're still exporting more and producing more. We just don't need as many people to achieve that. On another note, the tech sector in Calgary has been doing well for quite a few years. We've talked about it in some of our previous presentation. We looked at the 2024 and I think 2023 as well here. But this is the latest one this year. We're still doing pretty good. I mean, when you look at where Calgary stands, we're standing right next to cities that are known to be tech cities, right? Like, Montreal has more of a reputation for tech. Obviously, like San Francisco is still up there, but like Calgary wasn't even on that chart before, and Edmonton wasn't either. Like we were not in the top 50. We're probably not even in the top 100, and now we're making those lists. So I think it's reassuring for diversification going forward for our city. And as they know, we're the fastest growth rate of any market. So we're not up there, and we probably never will be, but we are growing very fast. So that situation's changing for the better. And I'll hand it out to Layne. He's going to have a bit of a talk on economy and inflation.
Okay, so this is really a recap of this part of the presentation is a recap of something I actually did in July, and it's because it's actually really important. So yeah, inflation is coming, whether you want it or not, good or bad. I would argue that's actually good for those people in this room. Overall, it's bad for society, but it's can be good for people in this room, and I'll get into why that is. So actually the first thing I'll do is just get a hit what, really break down what inflation is. This is going to be common sense to a lot of people that really understand this, and some people are going to understand. Part of it's actually just about describing inflation, but really so it ties directly into why that's so valuable in real estate. It's not like gold where real estate is inflation proof or it's a hedge against inflation. It's actually far more valuable, and that accelerates real estate. So just imagine, for example, right now it's 2025. So minimum wage, $50 an hour right now. And we can imagine X amount of years. That's, should be 25 years, the minimum wage is gonna double. But it's probably gonna be 12 years, 10 years, 15 years. And we'll get into a little bit of why that is. But just over X amount of years, we won't get into that part of the discussion yet of how quickly we think that's gonna happen. But at some point, the numerical value of everything is gonna double. So minimum wage is gonna be $30 an hour. Now, does that mean we think that if you look back, I look back at my first job at $7 an hour, or it was $7 an hour in BC at the time, and I don't particularly look at kids today working at minimum wage jobs think they work twice as hard as I worked. I just think that now we call $7 an hour 15, and a jug of milk used to be $3 or $2.99, and now it's $6.50. Now it's not a bigger jug of milk, still the same 4 liters. We just now call it $6.50. So at some point, we're going to be calling minimum wage $30 an hour. Still, it's going to be an hour of work by an entry-level person. At some point, a jug of milk is going to be $13. It's still going to be 4 liters. We're just going to call it $13. Bag of groceries is going to be $30, or that is currently $30 will cost $60. So the minimum wage is still going to get you 2 jugs of milk for 1 hour worth of work. And you're still going to have to work 2 hours of minimum wage to get a full bag of groceries. So nothing has really changed. We just the number has changed. You know, let's say medium household income in Alberta or Calgary specifically is around 100. It's going to be 200. So you think that's great. What's that? Yeah. Assuming you buy a bag of groceries for $30 today, you buy that same bag of groceries. I don't know. You're buying something cheap, I guess. Yeah, exactly. No frills, and it was something very cheap. But again, we think $200,000 is a lot. It's going to be the same job that is paid $100,000. But that $100,000 will not, or that $200,000 won't buy you more jugs of milk or bags of groceries. The median, house price now, let's call it around $600, so about 6 times the annual income. Well, it's going to be 1.2 once everything numerically doubles due to inflation, but it's still 6 times the annual income. So your income doesn't help. A house isn't really twice as expensive. It's the same amount. Everything's basically just kept pace. The only difference is we now call it twice what we call it. So that's inflation. I think most people to some degree understand what inflation is. So the difference is when it comes to a mortgage, and why that matters is this. So you get a mortgage, 80 loan to value on an average median house today, and then you've got a this copied over, it wasn't supposed to, but you've got a mortgage on 480 of it. So now let's just pretend, for example, I was able to get you a mortgage at 100% or at 80%, and it would be an interest-only mortgage. Now I can't do that, but let's just pretend for a second that I could. And all you did was make interest payments. Now, let's say your tenant made those interest payments and you still only broke even, so you didn't even make any money on cash flow in spite of the fact that your payment was reduced because it was only interest only. So everything doubles, X amount of years go by, and now that house is worth 1.2, and you haven't paid anything off, but that $480,000 mortgage hasn't changed at all. So now you've got $720,000 worth of equity, and you haven't actually earned anything. You haven't actually paid any off. You didn't make any cash flow, but now all of a sudden you've got equity. Now, the reality is that that money won't be worth as much, but you still built in equity that you didn't earn in any way. Didn't show up in cash flow. It's considered a capital gain. But what's really happened is this 480 is now worth half as much. That's the reality of how we would look at it. In today's dollars, that is now going to be a $240,000 mortgage on what we would consider a $600,000 house. So that's why inflation, it isn't that inflation is, that real estate is inflation proof. It's actually enhanced by inflation. It accelerates the return that you get. It doesn't just help you, because of course rents are going to go up with inflation, the value is going to go up with inflation, but that's not what it really does. The really key to the value is the fact that it devalues the debt that you borrow to finance the actual real estate that you purchase. So the real value in real estate isn't that that it increases. It's not. It doesn't really appreciate. Now we call it appreciation, and it's easy to calculate that way. We just say we think we're going to see 3% appreciation. What we're really seeing is inflation. The house doesn't grow. You bought a 1,200 square foot bungalow 20 years ago. It's still 1,200 square feet. It didn't grow. It didn't get bigger. So you've just upkept it, but now it's called the different numerical value. And if you got a mortgage on it and didn't refinance, that mortgage would be a lot less, even if you hadn't paid any of that mortgage off and just had an interest-only mortgage. So that's where the real hidden value of inflation in real estate comes from. And a lot of people, even successful real estate investors that are great at owning and making money on real estate, don't necessarily understand that principle. They think it's appreciation. And again, it's an accurate way to calculate it. So there's usefulness in doing that. So the reason that I have this discussion, which is mainly an academic discussion, it's really, who cares then? If it doesn't actually impact the decisions you make, who cares that this is that this is what happens, and we just call it appreciation. And the reason why is the expectation of appreciation. And so how do governments pay off debt? There's two ways they can do it. So they can either increase taxes, which is pretty unpopular and also really bad for the economy. It has some counter effects. So when you increase taxes, you end up slowing the economy, and sometimes you don't gather more taxes. Or you can cut spending, which arguably you should do, but governments haven't done that in a long time. So there is the 1,000-year-old solution that is better than both these. Now, in economic theory, this is what you would learn. You'd learn about these two ways to balance a budget, but governments have the ability to do their favorite thing, which is inflation, aka investing in a country, they call it, but what they're really doing is printing money. And they've got a bunch of different ways. That the most recent way to do that, instead of clipping quarters or reducing the amount of gold inside of coins, which is the old way to do it, now they do something called quantitative easing. So they participate in the bond market by buying bonds, buying back their own bonds essentially. So Canada's economy in 2005 to 2015, we had kind of transferred into what a lot of people call the petrodollar. So our economy was an energy economy. And in 2015, the new government got in and changed it to the ability to borrow against residential real estate and spend on consumption economy, which is a little more wordy, but that's essentially what we did. Toronto prices of real estate, Vancouver prices in real estate accelerated over a 10 to 15 year period. From 2007 to 2022, Toronto itself had a 300% increase. So the same house, if you bought it, would have gone up 300%. In Calgary, during that exact same timeline, it would have went up zero, meaning we would have lost money to inflation in Calgary, which I'm well aware of because that's when I started buying real estate. But the ability to, when prices increase this much, it drives an economy. So you've got a 22, 23-year-old couple, 3 months on their first jobs, can go out and produce $1 million worth of kind of top line economic activity. So that $1 million then gets spread out. They go and buy that because they get to borrow it from the bank, who makes it up out of thin air essentially, and then gives it to this couple to buy real estate with it. And the bank's okay with that because they've got the real estate as security. But then the salespeople get paid, the construction workers get paid, the insurance people get paid, every electrician gets paid, the finance people get paid, the city employees get paid because they've tacked on part of what increased the values is they started at $10,000 worth of fees and taxes to build the average, say, condo. Then it went to 20, then 30, then 100, then 200, then 300. In Vancouver at one point it was $600,000 to build a single family house before you spent any money on the land or dug a hole in the ground. So $600,000 basically the government got. So that's 10 employees, maybe depending on what they get paid. That's 8 employees, full-time employees. And then those employees go spend money in restaurants and they buy cars and they participate in the economy, and then those restaurants do really well. So they invest some money with their stockbroker, who has to hire junior stockbrokers, and they all hire accountants, and then they all have to buy suits. And the tailor's doing really well because he's selling suits like crazy because everyone's making money. So that's the amount of economic activity that can come out of just one house being sold. And when you ever increase that amount by lowering interest rates and increasing the taxes, which make an ever increasing value and people speculating on that value, and they did this for such a long time that our economy became based on consumption. So we have 2/3 of our economy is consumer spending, which isn't actually that unusual for a Western economy, even more so in Ontario and even more pronounced over the last decade. So that's the problem is that we now have to unravel that. So when oil and gas, which makes up a good chunk of Alberta's economy, crashed in say 2015, we were getting $100 a barrel for oil, and then it went down to 30 something. We lost all that new economic activity, that top line revenue that comes in and then gets spread out through the economy in the same fashion. The difference is when we sold the $100 barrel of oil, the transaction was complete. We sold the oil, we got the money, it's done. When you borrow the money on real estate, doesn't matter what the balance sheet looks like, you have to pay that money back still. And that's the problem. As soon as the trigger was eventually that the interest rates went up and people couldn't handle the payments anymore, and everything just got too excessive, and the affordability and the inflation that all came along with it. So it all kind of hit at the same time, and that's what they're dealing with. So can they just rip that Band-Aid off and go bankrupt and have Canadian banks go bankrupt? And I'd argue that's not going to happen, because our banks are all too big to fail. We only have essentially 6 banks, and they're all too big to fail. And based on how they get funds and how they insure their funds, whether it's a CMHC upfront or whether it's actually a back end pooled bond fund that the banks sell to each other while insuring with CMHC, eventually the government who backs up CMHC and the other private insurers, we have either way, we're pre-bailed out. There's no bailout. No bailout would need to happen if our real estate collapsed, because it's pre-bailed out. It's already built into the cards. So taxpayers are funding all of it. One of the reasons that CMHC has changed one of their mandates. So one of their mandates was they really wanted to bring affordability back to these 2004 levels. And they recently changed that mandate. They just took this out. And the reason why is because it would bankrupt them. There's no way they could handle having real estate largely in Ontario cut in half in value. It would destroy the economy as well. It's already going to be tough on the economy, because now we have to replace that borrowing economy with something else, because we can't continue to borrow more and more. They're certainly not going to let it actually go down in value. So what they're going to have to do is essentially they're going to try and keep it flat at the very least. But what they do there to keep it flat for us, because of our affordability levels, is going to be really good for us. So the policies are set nationally. We don't necessarily need all these. We don't need interest rates to be this low, but they're going to be nice and low for us. It's good for the rest of our economy as well, that isn't driven necessarily by consumption based on borrowing against real estate. So this is actually just a chat GPT. I just grabbed as much information as I can, including projections, which are a little bit up in the air. This is based on, I think, the assumption that our new budget's going to be around 60 billion instead of balanced. And apparently there's rumors of it being higher, but I think that might just be a setup so that we're happy when it comes out only at 60. If it does, that means this is our debt trajectory. So, I mean, this is where it was prior to the financial crisis. Here's where it is now. And if you look at here, this is what's considered one of the biggest transfers of wealth in Canadian history, from poor and middle class people to rich people. Investment bankers, banks, private equity funds all love inflation because they use leverage strategies in almost everything that they do. And that in itself is what makes the money. But if you aren't an investment bank or a private equity firm and you don't do that, then the only other thing you could do is buy residential real estate. So for people like us, we can use the same leverage strategy. Do we think that the government's going to let private equity firms and our big banks go under? I don't think so. Plus, they have to pay off their own debt, which means they want inflation. The thing that stops banks from the only thing that stops governments from inflation, which they love, is when the citizens revolt, which they experienced a little bit of a few years ago, when finally people are like, hey, grocery prices are too expensive. So people are, number one, getting a little bit used to it. Number two, now they have somebody else to blame. They have Donald Trump's tariffs. That's just going to be they're going to blame, good or bad, whether you like him or not. He's now going to be the excuse for why they allow inflation to run away. Now, the other thing with inflation is if one country does it and no other countries do it, there's a price to pay. If our dollar goes down in value because of inflation, everything we import gets so expensive that consumers would revolt almost immediately. However, if all countries are doing it, which they are, then we're just going to likely see it. So all around the world, we're just going to see more inflation from all governments, and the value of all currencies going down in relation to real assets. This is basically the trajectory of the U.S. debt. This is the bond market agrees with the estimate of inflation coming. Gold is basically a hedge against inflation, and you could see what it's done since 2020. Pretty flat over the last few years. So this is 2024 still that I'm pointing at. This is what's happened over the last little while. There was, I'm gonna skip ahead. Oh, I missed, I had one in with Donald Trump's Treasury Secretary, Scott Bessent, talking about, and I like just his fancy wording on inflation, which was something to the effect of, we're going to we don't need to pay off debt. What we need to do is get the debt to income ratio in line, and we can do that by growing the economy. And he had some fancy words around that, but what he means is printing money. Like that's just a fancy way of we're just going to invest and print money. And that might be because they want to reshore a lot of their manufacturing because they see that as an actual geopolitical risk, which it may be. But he basically admitted we're not going to get the debt in line. The whole Doge thing was rein in spending for things I don't like, and I'm going to give it to other people. So he did not cut back. He didn't rein in with debt. He just redirected that debt elsewhere. So this is just evidence of inflation happening, right? Alberta Teachers Association, 12%, which is only 3% a year, 12% raise over 4 years. And they're saying no to that. Now, there's obviously other reasons in there as well, but obviously no matter what anybody says, pay is always a big part of why they say no. You see it now, BC, same thing. Their public sector service union is also on strike. The nurses got a 20% pay raise over 4 years pretty recently. And all of this just feeds into what we're doing, Canada Post, which is arguably almost obsolete, are still they're demanding I think a 19% pay increase when you add all these together. They were offered 13 plus some change, so it's like 13.59, I think. And they've said no to that. That's not enough for them. So, and arguably a lot of people say like you're losing money and you're obsolete. Like you're gonna push yourself out of job, but it's still a demand. People are saying no. There's been inflation. There's going to be inflation. We want more pay, but with the nurses getting 20%, it seems to be that's going to be an argument for everybody to get more. So I imagine this is going to end up at a higher percent as well. I don't really follow BC. I know there's some stuff going on in Quebec. I just don't have enough to speak on that. Other reasons why government's the inflation. Record number of retirees are currently depending on their houses for retirement. You can't have their real estate prices going down. One of the strangest things that's happened is conservatives, older people have always been conservative, younger people have typically been more liberal. Well, that swapped during the last Canadian election. That's very unusual, but one of the reasons that the older generation liked Mark Carney is because he said, don't worry, I'll keep your house prices high. No matter how, I'll do it. And inflation doesn't hurt them. They've got the houses. It's the younger people that it hurts because everything's more expensive, harder to break in. 5-year bond market, this is just evidence that even so the bond market is largely should be demanding a higher yield in a natural bond market unless they think the government's going to intervene. And this is kind of what's happened over the last 3 months. So I think that most people have confidence. I've been saying for probably almost a year that we're going to see quantitative easing again. I've heard some other economic commentators say it. I haven't seen any major big bank economists say it yet, but they're usually a little more reserved in their estimates. But quantitative easing, money printing essentially, the new version of it, is likely coming, and that's where inflation comes from. Yeah, economy in Ontario has become dependent on the housing. They just can't rip that away. We've already talked about that. Governments love inflation. Basically, it's a hidden tax. If your house doubles in price, but it hasn't doubled it relative to anything else, you still have to pay a capital gain on that increase. If your income goes up, even though it's just keeping up with enough to buy the same groceries, now you're paying a higher tax rate, but you don't buy more groceries with it. You just have less money left over. So investment bankers also love inflation because most investment bankers, private equity funds, which are becoming huge now in the US and to some degree in Canada, all of their strategies involve leverage, and they've been used to doing that for 20 years. And their solution, and these are all the brightest minds in the world, but their solution to everything is inflation. Government support, government bail us out. As long as the stock market's good, we're all good. That's not necessarily how people feel if you're working a fixed income job or you're on a fixed income and you're a retiree and you don't have assets. But it does solve the problems in the world of high finance and government. So now we have an investment banker. I won't say that Mark Carney's not a smart individual, but he comes from that world. He comes from the investment banker world, then the private equity world, and the central bank world. There's nobody more, there's nobody in the world with his combination of experience in loving inflation, let's call it. So just the idea that somehow now he also has one more reason to want inflation, and that's because it will solve a lot of his, government problems and spending problems. And we'll see, unless he comes out with a balanced budget, but I don't think that's going to happen. This is something we're all going to have to answer here. So will the market go up? Will the market go down? And the answer is yes. So that's the answer we're going to have to. Anthony made me say this at the end. What is going to happen?
Make you say this.
Yeah,
but,
yeah.
But, I mean, what we're saying essentially is that yes, we expect the market will be going down, especially as we head into next year and over the winter. I think there's almost no doubt that's going to be happening. But as Layne just talked about, I think we also expect that the market will be going up after that, right? So I think it's a period of a slump that we're going through. And once we're through that, I think we're going to start to see some recovery after. But there's going to be that period of time, right? When the transition right now.
It really like everything we talk about, I mean, this is long-term stuff. Nothing goes up evenly. Like the minimum wage in the grocery store and the house prices don't go up at exactly the same time. They go up over the place. In fact, the nurses and the teachers are actually demanding the high raises as a result of inflation that's largely already happened. They're making up for that because prices went up and they were stuck with their old contracts where it wasn't increasing. So nothing goes up evenly. But in real estate, if you're looking to be a long-term real estate investor, which I advocate for, it's all about buying the right property. It's not about getting the best deal. So when you're if you're flipping, which isn't necessarily real estate investing, it's a business, but if you're flipping, it's really important to get the right deal, and you definitely need to watch
you need to get the right market as well.
The short-term direction of the market's also very important. When it comes to long-term real estate investing, the best properties I bought were at the peaks of market that then went into downturns, but they're still my best properties, and I wish I had a portfolio full of only those properties. Because over the long term, it doesn't matter whether I paid, if you bought a house in 2000 for $112,000 or $117,000, would it matter today? Because it would be worth $600, and it would be a great cash flowing property with multiple streams of revenue, good parking, easy to rent. If it's one of those properties, then it doesn't really matter that you got a deal from a long-term perspective. So the argument is buy your properties when you're ready to, and you have the money to, and buy good properties. That should always be the focus. And then where do you think it's easier to buy?
And the thing right now in this market, and Santhosh and I really start to see this, is the options are really improving. Like we're starting to see higher quality properties come up on the market, and more options on them. It's still not like a crazy amount of options right now, but it's improved a lot. And as we discussed, in a slower rental market, that also matters a whole lot more than getting a good deal on the property. You still don't want to overpay for no reason, obviously, but getting a good layout, getting those streams of income is really important when the market slows down.
Yeah, and the nice thing is now you can take your time, or take a bit longer to go through the property, and you can put conditions in and do your inspection, whereas it wasn't.
You can do proper due diligence.
Yeah, do your proper due diligence before you purchase, right? So that gives you more options.
And obviously you need to make sure your numbers account for that, right? Like we expect that we're going to see a reduction in prices. We expect that the drop in rent will continue over the winter. So you need to make sure that you're okay with that and you're planning for that. But again, on the next year or two, it doesn't really matter that much if you're going to hold for 20, 25 years. Will matter a whole lot more if you have the right property for a portfolio.
Yeah, which, I mean, it's like a year I was like, I'm too busy, I got young kids, I don't want to, I'm not buying anything else. And then I bought 2 more properties because they're good properties. And those are properties that would have been gone. Like those would have had multiple offers immediately, overpriced. They would have sold $100,000 over what we got them for just because of the type of properties they are. And now the market's slowed enough that we can actually go get those good properties, still do a little bit of due diligence prior to buying them as well. So it's already opening up, and I expect that'll be the same way over the next year.
Yeah,
so
exactly.
Yeah,
Anyone have any questions? Awesome. Or if there's no questions,